March 18th, the major announcement impacting your money and your benefits. This is another really important one, and I want to take the time to point out all of the specific details, as well as exactly what we can expect on the 18th. What is going to be happening, what the major announcement is that we can anticipate, how this is going to play out, and of course how all of this directly impacts your money, your benefits, your finances, and your lifestyle going forward from here. Now, if you haven't noticed by now, there are a lot of things that happen every single month, every single week, and honestly, almost every single day that have a very real and very direct impact on our money, on our finances, on our benefits, and on our ability to just live our lives comfortably. And with all of these major changes happening all at once, all of it impacting us in a massive way, we need to pay very close attention to these things because the details matter. The specific numbers matter. The specific decisions being made by these institutions and these committees matter enormously to the everyday financial life of regular people. That is exactly why I bring this information to you here on this channel as regularly as I do, because I genuinely believe that the more informed you are, the better positioned you are to make good decisions for yourself and your family. All right, so let's get right into it. On the date of March 18th, we are going to be getting the next FOMC meeting, otherwise known as the Federal Reserve meeting. Now, the reason we care so much about this particular meeting and every Federal Reserve meeting is because of the interest rate decision that is going to be coming out of it and all of the downstream effects that decision has on our money, our finances, our debt, and our daily financial life. Now, at the end of the day, I want to be really clear about something up front. This is not just some dry economic announcement that only matters to people on Wall Street or people in fancy suits sitting in boardrooms somewhere. This is not just some little headline that comes out and says, oh, we're cutting interest rates by 25 basis points, or we're holding interest rates steady and keeping them right where they are. Yes, all of that is important in and of itself. But the reason I bring this to this community specifically, and the reason it genuinely matters to you and me personally, is because of what it means in very real, very practical, very everyday financial terms. Because at the end of the day, if you are anybody who is floating a balance on a credit card right now, this affects you directly. And a whole lot of us are floating balances on credit cards. We have well over $1 trillion in total credit card debt in this country collectively. Think about that number for a second. $1 trillion in credit card balances being carried month to month by regular American people. So, I think it is absolutely fair to say that a lot of us, myself included by the way, I'm not sitting here pretending I'm exempt from any of this, are carrying some kind of balance. And when interest rates come down even just a little bit, it is actually pretty significant and pretty important because it directly and immediately impacts how much money you are paying in interest every single month. And if you are anything like me, you cringe every single month when you go to look at your credit card statement, make your little payment, and you see just how much of that payment is going purely to interest. It is painful. It is genuinely painful to watch. It is like throwing money directly into the trash. You are not paying down your balance in any meaningful way. You are not buying anything new or anything enjoyable. You are just paying the bank to carry your own money. And I think a lot of people in this community know exactly that feeling, right? It adds up very, very fast, especially when the interest rate on a credit card is sitting at 21%, 22%, 24%, or wherever it happens to be right now. Rates vary across the board depending on your specific card, your credit score, your card issuer, and a whole bunch of other factors. But across the board, we are talking about credit card interest rates that are very, very high right now. By any historical standard, it is a lot of money being wasted every single month by a lot of people who are already watching every dollar very carefully. But here's the thing I also want to make sure is clear. It is not just about credit cards, even though credit cards are probably the most immediate and the most obvious example for most people. This Federal Reserve decision also impacts auto loans. It impacts adjustable rate mortgages. If you have a mortgage with a variable or adjustable rate, any movement in the Fed's benchmark interest rate will eventually filter through to the rate you are paying on your home. It impacts lines of credit, things like home equity lines of credit, personal lines of credit, business lines of credit. Basically, if you have any money floating on any type of debt instrument that has an adjustable or variable interest rate, then the decision that comes out of the Federal Reserve meeting on March 18th has a direct financial impact on you. Every single time they meet and every single time they announce a decision, it ripples out across the entire financial landscape and eventually touches the wallets of millions and millions of everyday people. That is why this matters. That is why we pay attention to this. Now, the Federal Reserve holds these meetings once every approximately 6 weeks. Their last meeting was at the very end of January, which was also a very important meeting. They all are. And now, this next one lands on March 18th. It is a 2-day meeting that starts on March 17th, and then wraps up kind of around the middle of the day on March 18th, which is when the formal announcement comes out. So the 18th is the date you want to have circled on your calendar. That is when the decision drops. That is when Jerome Powell steps up to the podium and tells the world what the Federal Reserve has decided to do with interest rates. Now, what exactly are the options on the table? Because I think it is worth walking through all of the possibilities clearly so that you understand the full picture going into the 18th. Option 1, they pause. They hold interest rates completely steady and do not move them in either direction. They look at the current economic data, they look at where inflation stands, they look at the labor market, they look at all of the various indicators they monitor, and they decide that right now the appropriate move is to sit tight and do nothing. That is entirely a possibility, and honestly, based on what I've been watching and following, it would not surprise me at all if that is the outcome of this particular meeting. Option 2, they cut interest rates. They decide to reduce the federal funds rate by some amount, typically in increments of 25 basis points, which is 1/4%, though they can move in larger increments if they feel the situation calls for it. A rate cut would be welcome news for people carrying variable rate debt, because it would eventually, not always immediately, but eventually, work its way down to lower interest charges on things like credit cards, auto loans, and adjustable rate mortgages. Option 3, and this is the one that I think catches people off guard when I mention it, they could actually raise interest rates. They could increase them. That is still very much an option on the table, and I think a lot of people don't fully realize that. We have been in a cutting cycle recently after a long period of aggressive hikes, and so the idea of going back in the other direction feels unexpected to a lot of people. But here is why it is a genuine possibility that cannot be totally dismissed: inflation. Inflation has been moving in the wrong direction. It has been ticking back up rather than continuing to come down toward the Federal Reserve's official target of 2%. And when inflation moves in the wrong direction, the Fed's primary tool for fighting it is raising interest rates. Higher rates make borrowing more expensive, which slows down economic activity, which theoretically reduces inflation over time. That is the theory. The reality of how it plays out for regular people is that it makes all of that debt I just mentioned even more expensive to carry. So the Fed has a very difficult balancing act here. They are trying to manage inflation back down to 2% without overcooling the economy and without inflicting too much financial pain on everyday households. That is not an easy thing to thread. It is genuinely one of the hardest jobs in all of economic policy. Now, let me bring up something that I think is really important, and that adds a very interesting additional layer to this particular meeting, and to the next one as well. The current chairman of the Federal Reserve is Jerome Powell. Jerome Powell has been in this role for several years now, and he has navigated the Fed through some genuinely extraordinary economic circumstances, including the post-pandemic inflation surge and the most aggressive rate hiking cycle in decades. Now, here's the thing I want you to know about the timing of all of this. Jerome Powell is only going to be present for 2 more Federal Reserve meetings. This upcoming meeting on March 18th is one of them. The other one comes at the very end of April. After those 2 meetings, Jerome Powell is done. He is out in May. His tenure as Federal Reserve Chair is coming to an end, and he is going to be replaced with a new chairman who will step into the role in the middle of May. So we are talking about the final 2 meetings of the Jerome Powell era at the Federal Reserve. That is actually a pretty significant thing when you think about it. These are the last 2 meetings before the leadership of the Fed changes hands entirely. And that change in leadership has some real implications for where interest rates might be heading, which is something I want to address directly because I think it matters a lot for the people watching this channel. Based on the commentary that has come out, based on some of the public statements that have been made, and based on what we know about the administration's preferences and the direction they want the Federal Reserve to take going forward, there is a pretty strong expectation that after the new Fed chair steps in, interest rates are going to come down significantly faster than they have been coming down under Jerome Powell. Powell has been known for being very measured, very methodical, very cautious, very data-driven. He does not like to make big, sweeping moves unless the economic data clearly and consistently supports doing so. The incoming replacement is expected to be more aggressive about cutting rates, more willing to move quickly, and more willing to prioritize lower borrowing costs. Now, what does that potentially mean for you? If that expectation turns out to be accurate, it could mean that the cost of carrying that credit card balance, that auto loan, that adjustable rate mortgage, that line of credit, all of that could start to come down more noticeably in the second half of 2025 and into 2026. Not overnight, not all at once, and not without some uncertainty along the way. But the directional signal, if this plays out the way many people are expecting, is toward lower rates and lower borrowing costs for everyday people over the next year or two. And again, every single dollar that stays in your pocket instead of going to interest payments is a win. That is not a small thing. That is real money. That is grocery money. That is bill money. That is money that makes the difference between a comfortable month and a stressful one for a lot of people living on fixed incomes or tight budgets. Now, with all of that said, let me tell you what I personally think is most likely to happen on March 18th. And I want to be clear that this is my read on the situation based on what I've been following and the information available. Not a guarantee, not a certainty, because nobody knows for certain what the Fed is going to do until they actually do it. But based on everything I've been watching, the inflation numbers, the economic data, the commentary coming out of the Fed, and the overall environment, I would not be shocked at all if they simply pause at this meeting. I genuinely would not be shocked if they hold interest rates right where they are, do absolutely nothing, and just sit tight. And then do the same thing again at the end of April meeting. Pause, and then once the new chair is in place in May, that is when you potentially start to see some more meaningful and more aggressive movement on rates. That is my read on how this might play out. I am not saying that is definitely what happens. I am saying it would not surprise me at all. What would surprise me more, though it is still a possibility, is a rate hike right now. Given everything going on with the economy and the political environment around the Fed right now, hiking rates at this specific moment would be a bold and surprising move. But I am not going to sit here and tell you it is impossible, because it is not. It is always on the table as an option. The key thing is to watch what happens on the 18th, and then pay attention to what Jerome Powell says at the press conference that follows the announcement, because often the language he uses and the tone he takes tells you almost as much about where rates are heading as the actual decision itself does. Now here is the bottom line, and why all of this matters so much specifically to this community and to the people watching this channel. We are living in a moment where every single dollar genuinely counts. Inflation has been eating into purchasing power. Costs have gone up across the board: groceries, utilities, rent, medications, everything. And at the same time, a lot of people are carrying debt at very high interest rates, which means more of their money is being lost to interest every single month, rather than being used for things that actually matter and actually improve their lives. When the Federal Reserve makes a decision on March 18th, it is going to ripple through the financial system and eventually land in your wallet in one way or another. Whether that means your credit card interest rate nudges down slightly, whether your HELOC payment gets a little bit smaller, whether your auto loan refinance possibility opens up, these are all real, tangible, everyday financial consequences of what happens at that meeting. It is not abstract. It is not just for economists and financial analysts. It hits home for the people watching this right now. And that is exactly why I watch this stuff as closely as I do. I like to watch the inflation numbers. I like to follow the announcements out of the Fed. I like to stay on top of all of these details simply because, like I said a few minutes ago, I am floating balances on credit cards just like a lot of you are. I am watching interest rates just like a lot of you are. Every basis point matters when you are trying to manage a budget and make every dollar stretch as far as it possibly can. And I think we can all probably agree on that. Every single dollar counts right now. Every single dollar. Anyway, I am here for you in any way I possibly can be, and I just want to bring this information to your attention in the most clear and useful way I can. I genuinely hope this helps you understand what is coming on March 18th and what it means for your money. As always, if you have not done so already, please consider subscribing. Completely free, big subscribe button right down below. Please share the video as well. Big share button down below. because there are a lot of people out there who need to hear this and who would benefit from knowing what is happening. And if you have not done so, make sure to check out any of the other well over 6,000 videos here on the channel in the video library. There is a tremendous amount of information in there that I think a lot of you would find very helpful. Otherwise, if you have not done so, please consider subscribing, share the video, and until next time, have a nice day. Take care. I genuinely hope this helps you, and I will catch you again later in the next video or in the next live stream. I'll see you then.